Have you ever walked into a bank, applied for a loan online, or received a notification about suspicious activity on your account and wondered how did they know so fast? Chances are, a powerful force was working silently in the background, analyzing your data in real time, learning from past behavior, and making decisions in milliseconds. That force, artificial intelligence. While the term AI might make you think of robots or chatbots, what banks are doing with AI is far more sophisticated and, in many ways, invisible. From fraud detection to personalized customer service, investment advice to risk assessment, AI has quietly become the backbone of modern banking operations. In this video, we're diving deep into how banks are using AI behind the scenes. Not the flashy stuff you see in marketing, but the real, operational systems running 24/7, transforming the financial world as we know it. Let's peel back the curtain and see what's really going on. For decades, banks operated with armies of human analysts, paper trails, and reactive systems, but all that changed with the rise of machine learning and big data. AI in banking isn't about replacing humans, it's about enhancing decision-making, speeding up operations, and reducing risk. In fact, many of the biggest global banks today run hundreds of AI models simultaneously, analyzing everything from transaction patterns to customer emotions during a phone call. So, where exactly is AI being used in banking? Let's start with something most people are familiar with: fraud detection. Every time you swipe your card, transfer money, or withdraw cash from an ATM, an AI model somewhere is evaluating that transaction. Is it normal for you to withdraw $500 in the middle of the night from another country? Not really, so the system flags it. Sometimes, it even freezes your account automatically. But how does it know? These models are trained on millions, even billions of historical transactions. They learn what's typical behavior for a customer, what's typical behavior in general, and what patterns are red flags. Then they assign risk scores to each transaction. This all happens in real time, not minutes later, milliseconds later. Banks also use AI to detect money laundering, which is a whole different ballgame. Money laundering schemes are often complex and layered across multiple transactions and accounts. Traditional systems might miss the signs. AI, on the other hand, can connect the dots across multiple data points, analyzing sudden changes in deposit sizes, unusual transfer patterns, or activity across geographies. The result: suspicious activity reports are now more accurate, and banks can act faster. Now let's talk about something more personal: customer service. Gone are the days when customer service meant long hold times and scripted replies. Today, AI is powering virtual assistants that understand your questions, respond in natural language, and even learn from every conversation. Many banks are deploying natural language processing tools that analyze not just what you're saying, but how you're saying it. Did your voice get shaky when talking about a missed payment? That could be a sign of stress or confusion. AI models are being trained to pick up on tone, pauses, and even emotion to guide the response better. Behind the scenes, AI is also helping human agents by suggesting answers in real time, retrieving information from massive databases, and predicting why you're calling based on your recent activity. This leads to faster, more personalized service and fewer frustrated customers. But customer interactions go beyond phone calls. Email, chat, social media. AI systems are monitoring it all, routing inquiries, prioritizing urgent messages, and ensuring consistency across every platform. Let's shift to something more technical: credit scoring and loan approvals. Traditionally, your credit score was based on a fairly limited set of data: your repayment history, credit utilization, and a few other financial metrics, but AI has changed the game. Today's models consider hundreds of variables. Not just your bank history, but your spending behavior, income patterns, job stability, even how often you change your address. This is known as alternative data, and it's helping banks offer credit to people who may have been rejected by traditional models, like gig workers or people without a long credit history. AI models also improve over time. If the system notices that people who spend a certain percentage of their income on rent tend to default less often, it starts factoring that in. It's adaptive, learning and refining its decision-making process continuously. This also helps reduce bias. Traditional credit models were often based on outdated assumptions. AI, when trained responsibly, can reduce discrimination by focusing on patterns that truly predict financial behavior, not just demographics. Let's not forget about investment and wealth management. Robo-advisors are perhaps the most public-facing example of AI in banking. These platforms use algorithms to recommend investment strategies, balance your portfolio, and even rebalance it as market conditions change. But the AI doesn't stop there. In high-net-worth banking, AI systems analyze global news, social sentiment, and macroeconomic trends to provide advisors with real-time insights. They can simulate market scenarios, assess risk exposure, and even generate reports tailored to each client's portfolio. And this isn't just for billionaires anymore. Many retail investors now have access to tools once reserved for Wall Street elites. Let's now dig into risk management and compliance. Banks operate in one of the most heavily regulated industries in the world. There are thousands of compliance rules, both local and international, that need to be followed. Breaking a rule can result in huge fines or worse, the collapse of trust.